Okay, testing. 1, 2, 3. Hello. We are live. Well, we're not live. This is definitely pre-recorded. My name is Nolan Smith. I am the owner of Ocean Vale Mortgage and Finance. Thank you, everybody who has tuned into this, whether it be on video or audio, wherever you're watching or hearing this. Thanks for tuning in. I just wanted to launch a little bit of a new platform for the company here, and I'm going to call this platform On the Way. And the reason I'm going to call it that is because I'm a big fan of educating, realtors and professionals in our market. I feel like if we're all more knowledgeable, we're all going to be better, and we're going to have a better market altogether in this community. So you'll always catch me doing events for realtors, educating in that way, and this is sort of an extension of that. And I'm going to call it On the Way because I know realtors are running around town at all times, doing listing appointments, showings, all that stuff. So these are going to be short nuggets that you can listen to while you're driving, stuff that you can kind of pick up and maybe pass along to your clients and make you look like a rock star. If you're not looking like that already, that is. I know there's a lot of rock star realtors out there. So anyways, here's my contribution to that. So let's dive right into it. The first topic I want to touch upon, I guess on episode 1, would be Silicone Valley Bank. I'm sure that those of you listening and watching have heard about this. You probably might not know too much about it. You've heard Silicone Valley Bank collapsing and stuff like that. So I'm just going to kind of give you a bit of a synopsis on what's going on, what it means for us. First of all, I want to talk to you about who they are. So Silicone Valley Bank was the 16th largest bank in the United States. I think they had about over 200 billion in assets or something like that. And they mainly catered to, as their name would suggest, tech firms, but they also did a lot of healthcare firms as well. So, as a bank, they hold all these deposits, and what they do with these deposits is they will usually, invest them other places and sort of hold an IOU note to people who put their money into their bank accounts there, and they will earn money on those deposits elsewhere, and they will pay those people that gave them the deposits a smaller return on that, as I'm sure you guys are familiar with in our banking sector is exactly the same thing, and they keep the margin. Now, what happened was there was sort of a slowdown in VC funding, so they weren't raising as much capital. At the same time, with raising interest rates and all the uncertainty in the financial markets, a lot of customers started going to pull their deposits out of their bank account, and simultaneously, as they're trying to pull out their deposits, the Silicone Valley Bank had their deposits invested into the bond market. So what they had to do was start selling their investments to meet the demands of the deposits being requested, and they were selling them at a loss, and it snowball affected and caused panic, and eventually with more requests for deposits, they became insolvent. Now, insolvency is something that happens when a bank essentially can't meet the balance sheet requirements that the regulators give them, and if people are asking for the deposits, they have to, and they can't meet those demands. This is a big problem. So it's it's the second biggest collapse in U.S. history. I think in 2008, there's a bank in Washington. I forget the name of it right now, but that was the biggest one. This is the second biggest one. So that's pretty big in itself. So it's very significant. Now, so that's them. So how does it affect us? So in Canada, Silicone Valley Bank has a small subsidiary of theirs here in the country. And OSFI, who's our sort of bank regulator, they took control of those assets to create sort of like a ring circle around the problem, which is, to sort of like stop any further domino effect. So OSFI grabbed their assets, which isn't a lot. I think it's $800 or $900 million. And it's not deposits. That's just mainly bank loans and such. So what they did was they grabbed those, and they're going to sell those off to basically sort of like stop the domino effect. So that was Canada's first move. So now what's kind of happened is it's caused a bit of like hesitation in the markets. Any bank runs do that. People that hear there's an issue with the banking systems, especially from the shell shock of '08, will kind of run and just pull their cash out, and it just domino effect just stresses the system because all these banks have this money levered elsewhere, and it can't keep up with those bank runs, which is kind of like I said, causes a massive collapse like we saw in '08 in the US, which is crazy. So, so what we're going to see is some turbulence. I mean, we don't really know when this is going to end. It's sort of the start right now, so everybody's just kind of seeing how it's going. There's going to be some sort of turbulent times for investors. But here's what's going on with us. So specifically to the mortgage industry, this has affected the Bank of Canada bond yields. The Bank of Canada bond yields affect mortgage rates. Now, it's not news to anybody that rates have been atrocious lately. Well, I shouldn't say atrocious. Historically, they're not bad at all. But, given that we've been in the 1s and 2s for years, I know it's hard to kind of swallow being in the 5s. And that's sort of where we're at, mid-high 4s, low 5s. And we have been in the high 5s. So I know that feels weird. But what's happened is the 5-year bond yield a week ago was at 3.6 from the Bank of Canada, 3.6%. So that'll place, 5-year fixed rates in the high 4s and the low 5s. That's where they've been. In 1 week, that's come down to 2.9% as the 5-year bond yield. So what you're going to see is if that stabilizes and stays around the 2.9, 2.8 area, you're going to see 5-year fixed rates coming down into the low 4s. So we're seeing, that be an effect of kind of what's going on. As bond yields drop, so do mortgage interest rates. If this keeps going on and it keeps going downwards, and let's say a week from now it keeps that slide going from 3.6 to 2.9, and it drops another 0.7, and let's say it's at 2.2 now. So if we're at 2.2, you can expect 5-year rates in the coming months down the road to be around back into the 3s. So now we're around, probably 3.6, 3.7. And I love that. I hope that happens because that's just a great area to have rates and brings lower payments for our clients, and it really sparks our market. So that's one thing that's going to affect us. The other thing, the Bank of Canada has been, not just the Bank of Canada, I should say the market has been sort of speculating at a couple prime rate drops, overnight lending rate drops, which affect variable rate mortgages. And as I'm sure you know, those prime rates have been skyrocketing over the last year, and they've just held recently. It was the first time that they've held in so long, and they're sort of, the market is sort of pricing in a couple drops by summer. So this is sort of going to reignite our market, I think. So it can be good. Now, of course, it's not good if the panic keeps going and people keeps drawing deposits and down their deposits and it comes over into the Canadian banks. And people start pulling their deposits there, and that stresses that system. And then, possibly rates come down so low that inflation gets going again, and it's just a mess. So we hope that it sort of stabilizes and the bond market stabilizes, hopefully in the 2s. That would be great. You're going to see interest rates then, fixed interest rates then settle into the 3s, low 4s, which is very palatable for our clients anyways, and I think the general borrower. So that's what's going on. To summarize, here it is in a nutshell. People at Silicone Valley Bank got nervous and scared and tried to ask for their money. The bank could not keep up with those demands. They became insolvent. The U.S. government, when that happens, they have to act quickly before that happens in other banks. So they took control of all their assets. The regulators in Canada heard about that. There's a subsidiary of Silicone Valley Bank in Canada. They grabbed those assets, sold them, just to sort of create sort of a barrier around maybe a potential domino effect. Because of all of the turmoil, bond yields dropped. That means mortgage rates are going to drop. That means homes become more affordable, qualifying gets easier, and maybe you can sell more homes and we can do more mortgages, which would be great to return to a healthy market. And that's where we're at. So that's what happened. Thanks for tuning in. Thanks for listening. Thanks for watching. Please follow us. We're going to probably keep doing more of these little bits of information for you to hear about. Like I said, hot topics that are going around. Message us if there's anything you want me to talk about. Happy to take any requests. And thanks for tuning in, and hope everybody's well.